Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. It's another time for Twitter. We're going to go on there, take a look, see what people are talking about. It's going to be financial topics, wealth building topics, all of those things, commodities. And we'll go through it together. I'll give you my financial opinions and we'll go and rip right through it. So, again, if you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. Check it out. You can use the word discount for a coupon code. So we're going to start here. It says, I started investing 19 years ago. Here are the 19 harsh investing truths I learned the hard way. Losing money hurts 3 times more than making money feels good. Humans are pre-programmed to be bad at investing. Your personal finances are 10 times more important than your investments. Handle volatility is 100 times easier in theory than in reality. Confidence in your strategy will rise and fall in lockstep with asset prices. The best stocks put their owners through gut-wrenching volatility. The worst stocks do too. And guys, that means both good and bad stocks are going to put you through volatility. You're going to be wrong a lot. Be humble. It's never as good as it seems or as bad as it seems. Successful investing requires an uncomfortable mix of pessimism and optimism, which is damn hard for our brains to handle. Graduate school taught me a lot of complex calculations that only work in theory. History and psychology are the most important subjects for investors to study. History is your market conditions, interest rates, ratios, all that, and then the technical analysis is the psychology of people. Consistently avoiding ruin is the most underrated financial skill. Frauds, bad investments, good investments, and how to perfectly time the market are only obvious in hindsight. Interest rates matter a lot. I agree with that one. This is probably one of the most important things to follow is interest rates. The stock market will always attract people who are in a rush to build wealth and build wealth for people who are not in a rush. No amount of words can explain what a 50% drop feels like. Make more, spend less, invest simply, and wait longer is the best financial advice that he can give. So make more, spend less, invest simply, and wait longer. Consistently avoiding ruin is the most underrated financial skill. 99% of investors should dollar cost average into index funds and call it a day. So that's his opinion there. Coming back out, we've got Nasdaq update 2000 versus 2023. Keep time at bay, and we get the exact process of mass unwinding in all of its glory. Wealth destruction pending. Day traders can take advantage of the upcoming large swings. So here we go. This is the comparison between 2000, 2001 and what's coming. And you know what? This is the exact comparison that I would use. I think that the market conditions most closely align the tech stocks to the 2000 crash. What he's got here is a ABC correction. Then you can see there's in this correction, you've got a 1 wave, 3rd wave, 5th wave. So he's got the same type of setup, the same lead-in type move pattern, the double top, the move on up, and we could be in for a decline in the Nasdaq. I think that's actually highly possible. Could commodities go down with it? Yeah, we could have a recession. Yes, things could get kind of ugly here and move to the downside. I'm going to ride through it. I can, obviously might be best to save some cash up as well. But I do think that this is not being driven by the housing market, which makes this, it's not clear cut. In 2000, 2001, commodities, some of them went sideways, some of them had their pullbacks. Maybe we already have the bulk of the pullback done. Maybe we've got one last kind of washout sell, whatever it is. Like the guy said, everything's going to look very obvious in hindsight, very difficult to tell in real time. But this could be a potential outcome where we get another leg lower, what could be a very big leg in the Nasdaq. The Fed's biggest issue in one chart: rents are increasing fast again. And here's the median asking rent in New York City. I'm not a big city guy to be, just in general. But look at the rent price go up here. Jesus, we're way up there. I know rent here has increased dramatically in a very short period of time. What people say, oh, it's not good to buy, it's great to rent. Well, I can tell you this: my mortgage is way less than anywhere on this chart. It's like way off the chart, way down here, and it's locked in for 30 years. Good luck beating that. You couldn't even rent a one-bedroom apartment where I live for my mortgage. Not even a one-bedroom apartment. I'm not trying to brag, but it's just, guys, lock in your costs is a viable way to keep money in your pockets. And you're not going to be subject to all these costs that are flailing all over the place. At least that's my opinion. That's what I did. Coming on down, it says leading economic indicators are deteriorating at levels only seen 8 times since 1960. Each one ended in a recession. So we had the Nasdaq that I just showed you and the potential fractal that's aligning. We've got a lot of economic indicators that are also quite low. But here's the thing. This is what is different. When we looked at that Nasdaq, right? This was at 2001 and it went down during that crash and ended in late 01, early 02. We've already had that move lower. So the move has already happened. It's already in our rearview mirror. And maybe it goes on a little bit further, or a little bit, further. That could be the case. So if we were to look at this, go back up to the Nasdaq. The Nasdaq in 2000 came down, went up to about 2000, mid 2000s, and was done by the end of April of 2001. So if we were to overlay that with this, this is the crash here in this indicator, and it's kind of current contraction in the indicator is consistent with recessions in a prior decade. They called the recession after, but that was rebounding already. So this is looking backwards, and most of this move is, I think, already done, and we should be turning around at some point in the future. So maybe the slowness, maybe that tightness is already behind us, at least the majority of it. Maybe we just have a little bit further to go in time. I don't know. We'll see. Next, we've got platinum in the stock market. So everyone knows I like ratios. Check out the correlation that is part of this, or part of my thesis, that real estate and the demographic drives inflation. Case-Shiller index divided by the Nasdaq composite. Then we've got the platinum to gold ratio. And look at how these two are both linked up together. What that means is that when the housing market outperforms stocks, so does a lot of our commodities. They are interconnected. They are linked together. There's a high correlation there. And that's where I came up with the demographics driving real estate, and real estate driving inflation, and inflation driving interest rates, which then drives a rotation of money that is different based off of history. I'm just showing you some correlation there with this data here. So we've got the home price versus NASDAQ. And when that outperforms, you can see that we see an outperformance in the metals. So the metals front run the Case-Shiller index and the NASDAQ, that ratio. Here's real estate. It said real estate adjusted by inflation of gold and M2 money supply. Real estate divided by gold and real estate divided by the M2 money supply. And there it is. We're still at a very cheap level. So the Case-Shiller index, if you were to inflation adjusted divided by gold, so to speak, is cheap. It's also cheap when you look at it against the M2 money supply. So when people look at the Case-Shiller index and they compare it to history and say, oh, look how expensive it is, they're not taking into account how much money is in the system. They're not taking into account the inflation adjusted number, so to speak. So I want to talk about this one. This is Ferg on the right. It says you never really know what percentage is luck versus skill. Imagine you get 225 million people, the approximate population of the US at the time, to participate in a coin flipping contest. Each person bets $1 and flips a coin. If they call correctly, they win $1 from those who called wrong. Each day, the losers drop out, and on the subsequent day, the stakes build as all previous winnings are put on the line, Buffett wrote. With the rules and players in place, we can start to play the game. On day one, 225 million people flip a coin, and approximately half of the players fall out of the game. Day two, the same thing happens. 10 flips in, and you'll have approximately 220,000 people with $1,000. Now, this group will probably start getting a little puffed up about this. Human nature being what it is, wrote Buffett. They may try to be modest, but at cocktail parties, they will occasionally admit to attractive members of the opposite sex what their technique is and what marvelous insights they bring to the field of flipping. So, what he is saying is, even if you've got a bunch of people who have won in the stock market, it could be by random dumb luck that they continue to get things right. And what happens is people focus on the $1,000 that they have from $1. So they have basically 1,000 bagger on their hands. But those people did it by sheer luck. At least from this perspective, this is by sheer luck. This example is. There's no rhyme or rhythm or reason that these guys won, and there's going to be people who have to be a part of this 220,000 just by statistics. So whatever method that you develop or whatever strategy you have, some of it may be by dumb luck that you do very well. Where strategy comes into place is being able to consistently get a return that is above average. And that is what's very difficult. That's where I came up with the thesis. I continue to dive and dig and see what is causing the markets to behave the way that they do. I think I've got a pretty good thesis. I think the strategy is very solid. But in the short term, you're always going to have these moves that are going to go counter to what the thesis is, because markets move in waves. Coming down to Ferg, we've got when there is no intrinsic value or cash flows, outrageous price predictions and unwavering confidence are required to keep greater fool theory in process. Total market cap of stocks with a price to sale ratio greater than 20x. This is total market cap. You can see a big bubble here and then all the way back down for the tech bubble. And look where we are today, guys. We are in another bubble. So get ready. That bubble will pop at some point. China is again on the cusp of deflation. In the past, that has been a consistent indicator of global recessions. We could see a pullback here. We're right on that cusp. I know they're doing a lot of stimulus over there. Maybe that's working. But remember, I showed a graph a little while back on a thesis update where the demographic and coming into home buying years is contracting quite dramatically. That's what they're dealing with. They're dealing with the contraction of, I should say, the demographic contracting to a large degree. That is or could be disinflationary or even deflationary if the real estate market has problems and crashes. We've got 2-year gilt yields. The UK is screwed. Look at this, guys. We are just rocketing higher in UK gilts in terms of their yields. That is really interesting how yields are just moving like they are. I mean, this went from 3.2% to 2% in a very short period of time. Is this the beginning of a domino effect that moves across the entire markets? It could be. So get ready. Be ready. So that's what I've got for today, guys. I'm going to end it there. If you guys like the content, give me a thumbs up. Subscribe to the channel. Subscribe to the website if you like. And hopefully went over a lot of stuff there that piques your interest, guys. All right, guys. We'll catch you next time. This is Finding Value.